Texas Claus is coming to town. Texas Claus is coming to town. Well, welcome to Your Money Radio, folks. I am your host for the 2022 Christmas special edition.
Oh my gosh.
Or if you're politically correct, the holiday edition. We call it the Christmas edition of Your Money Radio. And we have we have Michael, but not Ted.
No.
But we do have a special guest, Alex the Greek, that's going to come and make a special appearance. And he's going to talk about the markets. But you also have me, Texas Claus. Now, I am actually...
Dan, would you say you're the host?
Oh, there you go, Don. There you go.
Wow.
And my name is not Dan. It's Texas Claus.
Of course.
Anyway, I am actually Santa's second cousin once removed.
Really?
Or is that first cousin twice removed? Anyway, it doesn't matter. I can't remember. I get all that stuff confused. But Santa is hundreds and hundreds and hundreds of years old, and my birth was 1836. Okay? They call me TC for short. In Texas, but I really want to know. I came out of the woodwork. I want to go. I came over on my Ford F-150, and now I'm trying to figure out: do I want to go to the Ford F-150 electric version? I've heard it's got tons of torque. Here's the problem: what happens if my battery goes dead during delivery in Texas in the middle of the night? I can't. What do I do?
You got a lot of land to cover.
Well, I do. That's a lot. So I don't know if I'm going to go the electric, and we're going to actually touch on that a little bit later. But I want to track Santa Claus down and find out where is this Christmas rally we always hear about.
Yeah, how is that second cousin of yours?
Yeah, how's that work? It's not working out. Anyway, we've been pretty good. We've been pretty good this year. And we need to track down St. Nick and find out. Did I tell you I was his second cousin? Anyway.
Did you? Yeah, I think you did.
All right. So, but before that, we're going to go to the Your Money Radio mailbag, and we're going to talk about a mea culpa, Stan Weinstein stage analysis, and the China-U.S. manufacturing from the mailbag. And then we got to talk about SBF, Mr. Scam Bank Run Fraud. He was arrested, thank God, stealing from clients, just flat out. But will he get pardoned? Woo, don't know. All right. And is Edward Jones, they're offering these new personal managed accounts, okay? Or is it just the same lipstick? Is it just lipstick on the same pig? We'll talk about that, and then we're going to talk. And I did put a couple articles on Social Security if you're widow's benefits, but you can read the article. If you got any questions on that, reach out to me. I don't want to grind the show to a halt. And then finally, earnings, not inflation and not rates, interest rates, rising interest rates are going to be the next driver of stocks going forward, okay? And we're going to talk about that. We're going to have Don teed up, and we're going to talk about that. But first, we are going to go to the mailbag. So, the mea culpa.
The mea culpa.
Right? Because Don has a few trolls on Twitter, the different social medias. He'll get a few challenges, and that's okay.
Don's got a following.
That's all right. You got people disagree on strategy and how to manage money or whatever. After a while, Don's kind of had his fill and got enough, and he'll get a little snarky and have a response back. Anyway, but I actually got this in the mail. I don't know if you can see this, but I actually got this nice card in the mail, and it says, Don, I'm sorry for trolling you online. You do a fantastic job, and know that your videos impact a great many people.
Wow.
Please accept my apology. Well, that was very nice.
That's very sincere.
So we got one convert. Hopefully.
That mailed with postage?
That was mail. That was snail mail, baby. That's how you know the guy's serious. I mean, if he's going to take the time to handwrite it, put a stamp on it, put it in the mail, but besides sending out all of my dry rub, the Pasilla rub I make for all the clients, I send it out every year.
Big hit this year.
I mean, if you're not a client, you ought to join just
the
to
blend
get the dry
this year,
rub. Right?
You wouldn't believe.
But anyway, I need to give you some, by the way.
Yeah.
It's very good. But all right. So now in the mailbag, okay. But besides that, I haven't mailed anything since last time I mailed the dry rub to clients.
Yeah.
You can't email the dry rub. All right. So then the second mailbag, and folks, listen, if you've got any topics you want to talk about on the radio, you got a stock you want us to bring up, or you got an idea, or you want to berate Don, if you want to troll Don, send us an email and we'll put you on. And I won't out you unless you tell me you specifically want to be outed. I'll keep your name discreet.
Right.
All right. So next one. Dear Dan, really enjoyed your daily and weekly videos. Well, I appreciate that. I'm not really doing them. It's Don and the other videos,
in general.
Yeah. Okay.
So
he said, mailbag. Since Ted worked on with Stan Weinstein, would love to hear him talk about using the 150-day line versus a 200-day line. Has anybody, I presumed, compared the two lines for effectiveness? Thanks so much. And I said, hi, M. Thanks for the M. He's like James Bond's trinket maker, M. He was the guy who made all the stuff.
Yeah.
Thanks for the message. From reading Weinstein's, this is Ted. Thanks for the message. From reading Weinstein's books and working on his stage analysis masterclass, Weinstein has explained that he used the 150-day/30-week as his gauge for trend. I've looked at many charts with stage analysis cycles, and I found the 150-day/30-week works well. But if your style is more conservative, then the 200-day/40-week would give you a later confirmation, later confirmation, but more definite. Thanks, Ted. I said, this is me now. M. It will make the mailbag, although Ted will not be on tomorrow due to finals. Good luck, Ted.
Good luck, Ted.
We will have but we do have a special guest. We will, however, read his answer. Now, before I go to Don on that very quickly, okay, I do want to point out, because this is kind of a interesting idea. So Ted actually in his email said, but if your style is more conservative, the 200-day/40-week would give you more confirmation. Now, a 200-day, 40-week is longer by 25%, 150-day moving average versus 200-day moving average. So the 150-day is a shorter term indicator, a little bit shorter. So it's less trading, but you could have, you'd have less trading, okay, with the 200-day. With the longer one, you'd have less trading, but more drawdown. So which is more conservative? Is trading more conservative and less drawdown, or not trading? I know the regulators don't like trading. They like the pie chart. But that's just a philosophical debate that we could certainly have. But I just wanted to point that out, because when Ted said the style is more, the 200-day is more conservative, I think that's kind of open to interpretation. It depends on what your thoughts. Yeah. Before we go to the next mailbag, which is an awesome letter, Don, I want to get your thoughts on that real quick.
Yeah, can you go bring up the chart, Zach?
Yes, absolutely.
So normally I use an 80 MA for the purple line here. I put a 150-day line on here. This was the 2021 uptrend, and you can see it really didn't. When you're in a strong uptrend, the 150-day doesn't really mean a lot. When you start pulling back, you can see we got within 1.2% of the 50-day before we bounced in October of 2021, and then below there is the 200-day. Now let's go to this year. And you can see the busyness over here. The 150 and the 200 are a lot closer as we start coming down. There's some jockeying back and forth, but the S&P seems to obey the 200-day moving average better than the 150-day. Here they're very close. This was really the key day of the year on 4/21 when we tried to get back up, failed, and then we went into the big leg lower. Here you can see it pays a little bit of attention to it. Every once in a while, I put one on here. It actually seemed to pay quite a bit of attention to the 150-day recently on this pullback when we failed 100-day. So we got up to the 200-day, failed, and on the pullback, we bounced right at the 150-day several times over the last 4 weeks. Let's switch now to a weekly, because it would be the equivalent of the 30-week moving average, and let's and again, it's the purple line here. I always keep the 20-week, the 10-week, 20-week, 30-week, and 40-week on my weekly charts. And you can see, occasionally we pull down to it. This was that October period of last year that I was talking about. And it's more of a guide. I don't know that one is better than the other, but Dan pretty much summed it up well when he said you would have less trades with the 200-day. It is certainly, hey, pay attention here. If we break the 150-day, can we go down that extra few percent to the 200-day? So if we bounce off of it in an uptrend, great. And then if it starts acting as support or as resistance in a downtrend, that's very obviously a negative. If you look here, the 20, I said the 150-day, the 30-week, but if you note the 20-week and the 30-week, which means the 100-day and the 150-day, were pretty much overlapped over the last 4 weeks. So arguably it was a double shot of support, which it held for 1, 2, 3, 4 weeks, and then finally broke this week, again indicating a change in character with the reaction to the Fed on Friday. So the bottom line is the industry standard is the 200-day. Weinstein's 150-day does have a lot of followers, and it does depend on your time frame. There's uses for both. We pay more attention to the 200-day from the standpoint that it's always on our chart, but when it's appropriate, we'll add the 150 onto the chart, and we always have the 30-week on there. So bottom line is we are taking it into consideration. I don't think it's going to make or break any decision. Ultimately, if you're at the 150-day, you have already broken down below the 50-day, so the market is not at its healthiest. And it's at that point, it just becomes a reference point for, is it going to hold that support or resistance?
Yeah. So now, folks, the 200-day is institutionally followed by a lot of big pension funds, hedge funds, institutional money, mutual funds. And so probably more people trade off of that or longer term, or make some portfolio pie chart adjustments, asset allocation rebalances. The 150-day is used much less by longer term fundamental players, and much more is used a lot more by active traders. All right, now, so the next mailbag, and this is actually a great. I'm gonna have to read this because this has a lot of good stuff in it, a lot of jewels, and this is actually from a client. Don, you mentioned Tesla in Tuesday's recap. My opinion, for what it's worth, on Tesla is that Elon mistakenly sunk enormous capital into two nations and that are going to struggle going forward, China and Germany. Tesla's German factory still has fresh paint, just at the moment the German export model is breaking. Germany must find a new source of energy. Russia's cheap energy is gone and not likely to return anytime soon. So whatever energy Germany finds will be too expensive for their manufacturing to make a profit at market prices. The powerhouse German manufacturing and export machine is no more. I don't think that realization has sunk in yet for the Germans or for the European Union. Things are going to get ugly there. China has become very unstable, and the U.S. has simply cut them off. No more high-end semiconductors to make high-end products, plus the issue of COVID. Lockdowns have been rejected, finally, by the mass protests. So now we wait and watch to see if the death rate in China gets extreme. Who knows? Unstable society. But bottom line is that the West has finally had enough of China as an unreliable supplier and a thief of technology, and is moving their capital and infrastructure out of China. So China as a base for U.S. manufacturing does not have a good future. Apple, in a case in point, at Foxconn. And I believe Apple is in a multi-year scramble to find a new home for their manufacturing. Fortunately for Apple, they are sitting on a boatload of cash, so they will survive. But they are not in a good place right now. Bottom line, although I'm a big fan of Elon Musk, I believe Tesla has made a strategic error basing their new Gigafactory in Germany. They must have skipped the paragraph in their market research that talked about a source and stability of energy in Germany when they were thinking about creating the factory there. And China is a hot mess and will impact all the heavyweights who source products from there, i.e. Apple and Tesla. I foresee a real decline in China as an exporter. Ergo, I foresee the real problem for the CCP and the Chinese domestic market. Dark hole. Tempting as it may be, I'm not interested in investing in an opaque nation. As we look at which companies will lead the next leg up, he's looking for leaders, next stock leaders. I would eliminate those who were slow to see and anticipate these strategic changes in the marketplace. I'm looking for those companies who will benefit from those changes and are likely to be basing their manufacturing in Mexico and the United States. Listening to my thoughts on this. Oh, thanks for listening to my thoughts on the subject. Thanks from the Peanut Gallery. Now, while I agree with a lot of his things, he said at the very bottom, I'm looking for the next leaders, but I don't think Tesla and Apple will be that. You don't really know that. You'll let the charts tell you. The charts will start telling you which ones are leading. But if I had to make a hypothesis, that would be it. Okay, now, so we actually have some ex-Tesla employees, ex-Tesla engineers, and they are very knowledgeable. So I sent these because I wanted to get this guy's thoughts. He actually helped build the German Gigafactory, a couple of them, but and he was in Europe for quite a while, so he is close there and he knows these. He's actually had to deal with this. So I emailed this guy and I said, these are some interesting comments from another client we received. I agree with most of the comments on Germany, Tesla, Apple, and other companies' predicaments in Germany and China. I did want to get your thoughts, though, as you were much closer to the actual issues. I was going to summarize, but decided against it, letting you see the comments in their entirety. Again, just wanted to know how much or little you agreed with his thoughts and how important finding alternatives to China are. India is now shooting for top gun in the global manufacturing, and other countries like Mexico are options. Biggest question is whether this is just a, quote, COVID fad away from China or whether there's long-term implications. Thanks, Dan. So he answers back. He said, Germany is not too off. Energy security is a massive issue, and Germany does not seem to be handling this well. The Gigafactory still does not need much energy, so maybe there is still a chance, but Germany seems rough. However, even a doubling, this is kind of key for Tesla specifically. However, even a doubling in energy cost will change maybe a few dollars per car. He's talking about the price. What's more worrisome in Germany, he didn't put that, what is more worrisome is the plethora of labor and political problems in Germany. China is a different story. COVID and economic difficulties persist, but actually other countries like India and the U.S. have their fair share of problems as well. U.S. has the highest death rate due to COVID. I think this one is more balanced, and still the profitability and quality of cars from China is seen as the best fit for Tesla. So he's saying from a Tesla perspective, they still think China's a good fit. The Inflation Reduction Act is really what moves the needle for factory buildup in the U.S. If any reality of the incentives for the Inflation Reduction Act are diminished, then watch for significant weakening on industrial buildup in the U.S. So, Don, I wanted to kind of get your thoughts on that because we talked about that a little bit. Again, I think that you got to let the charts lead you, because those are two different opinions. Even though they're similar, they're not perfectly in line. They disagree a little bit. So, in any event, how are you going to determine when Tesla or Apple is a buy or out of the woods? We don't own either.
Zach, can you go to the chart?
Absolutely.
This green line, plain and simple, this is the declining 21-day moving average that has been acting as resistance for Tesla going back to late September. Attempt to get back above it in late October failed, rolled over again. Attempt to get back above it late November failed, and it rolled over. So very clearly, a change in character for Tesla would be if it gets back above the 21-day exponential moving average, the green line, and the slope of the line turns back up. That will be a short-term change in character for Tesla, and that would be the first time I would even entertain buying it. But the fact that this break below the 200 level, you can see the 200 to 210 acted as support back here in May and June. It acted as support here in late October. Then it broke it, tried to get back above it twice in early November and in late November, early December, and failed again at 200. That's a brick wall now that it needs to get through. You can see the 50-day moving average is coming through. That Tesla has a lot of work to do before you forget the fact that there's overhead supply. Everybody that owned it up here, everybody that bought it is looking to get out at break even. So anytime it would come up to 200, I would expect it to get rejected. Now, granted, it's $50 below that. It's trading at 150, but it's still in a downtrend. So could you say, well, I got to buy it at 190? No, I'll get it at 180. That's better. No, let's get it at 170. No, it's 160. Let's get it at 160 now. And now it's at 150 when you'd been wrong at each level as it continues to go down. It's a falling knife. Falling knife, if you don't catch it, ends up in the top of your foot, and that hurts. Let it keep falling. Let it make a bottom. It's showing no willingness to make a bottom. Elon is distracted by what's going on at Twitter. He's selling. He sold more shares, a lot of shares this week, Tesla shares, to finance the big bills that he has coming to Twitter. And it's an avoid. If anything, it's a short. And we talked about a month ago in inverse ETFs, and there is a Tesla ETF that could have been used for this. I think it's TSLU. Yeah, I mean, that's a good looking chart. That's if you're short Tesla. It's going higher. So
that's inverse Tesla.
That's inverse Tesla, right? Which is the complete opposite of the actual Tesla. And I mean, it's an avoid. It may become, they've got great fundamentals. We keep stocks with great fundamentals on our watch list all the time, but the technicals have to match the fundamentals. And if they don't, it's an avoid. So that's what that is for us.
All right. Now, so and what Don said there was very, very important. I want to make sure you didn't miss that. Rather than trying to say, oh, this stock is cheap enough now, it's gone down enough, I'm going to buy it, I'm happy with that price. It's better to let it bottom out and start rising on strong volume. And even if you buy it 5% higher from where you thought it was bottom, because you're just guessing, okay? If you wait till it actually bottoms and then goes up 4 or 5% on strong volume, a lot of times you'll get it 15% lower. It's going to go down lower than you the market always will overshoot to the upside, not always, but usually will overshoot to the upside and overshoot to the downside because it's emotional. And so even if you buy it 5% higher, it's a less risky entry because you didn't know. You knew with hindsight, but you didn't know it wasn't going to go down another 10 or 15%. So what's Don saying is right now, if you decided to buy it at 180 or 170, now it's at 150. If it starts going up on really strong volume, you could get it at 160, not 180. You get it $20 cheaper. And that's what's important. More often than not, if you wait till a stock actually bottoms and then starts rising on volume, you will actually get more stocks cheaper than you thought by just trying to guess the bottom. All right. So we've talked about that. Let's go to Sam Bankman-Fried. Okay, I love that. I just love talking about him. Well, it's just so unbelievable. So he hoodwinked not only retail investors, he hoodwinked big hedge funds, Sequoia. I mean, he got states involved. I mean, he got people involved. That
Canadian Teachers Union.
Yeah, big.
$400 million.
Yeah, and they're, I don't consider them as sophisticated as like the hedge funds, like the Sequoias of the world. But in any event, so he was selling all these people on how they have this high tech, system, safety system, control system, so that people could not get over margined or over leveraged. Right. The only people, he said it was a fully collateralized position. It's a risk engine mitigation system that was very high tech, but his hedge fund that he and his girlfriend were running, Alameda, they didn't have the same system, and they literally just went and borrowed money, just took money out of clients' accounts and stuck it in the hedge fund and then gambled with it. And nobody ever said anything. And now Congress is actually, he's going to have to go testify, and that should be good. Here's the other problem. there's allegations that he made all kinds of illegal political. We know he made tens and tens and tens of millions of campaign contributions, but now it looked like a lot of them may have been illegal and over the limit. So Congress has to bring him up now because so many people lost money, but I don't think they want to. They don't want to shed light on this. There's also a deal where he was raising money for, remember, I support Ukraine, I back Ukraine, those things they were doing 6 months ago, raising money to help Ukraine. Well, he was raising tens of millions of dollars theoretically for Ukraine and funneling that right back to the political parties. It wasn't even going to the Ukraine. So,
love that.
Thank you, Sam.
Thanks,
Scam.
Sam. Yeah.
All right. So now the next one is the one I really like is Edward Jones. Edward Jones.
Old Ed Jones
is coming out with these new managed accounts. Okay. Now they said these models will include mutual funds and exchange funds. Well, that's all they use right now is mutual funds and exchange traded funds, I think. Anyway, it says our defined research model is pre-constructed. So it's already built and you get it. How do you know it's apropos? I mean, if they built it 3 months ago and now you're just getting it, I mean, we're modifying our portfolios all the time. But anyway, all right, it says, according to predetermined percentages, it says our home office managed models have been one of the most popular ways financial advisors help clients reach their financial goals. It basically, so they're going to take all your personal situation, your individual, they're trying to make it more personal to you. Mm-hmm. And then they're going to slightly tweak their pie chart asset allocation models to make it seem like it's customized, and it's going to seem slightly modified, but it's still going to be a pie chart buy and hold using ETFs and mutual funds. My question is, what is the sell? How will you know when to sell? Is there a sell discipline?
They'll tell you when to
Are
sell,
we
maybe.
just buying and holding? So without further information to make me think any different, my personal view, they're still doing the same easily cloned, duplicatable, replicable en masse system, so they can just print them out. Client comes in, here's your pie chart, move on. Next person. So here's the problem. They try to make it customized for you and your risk tolerance, and it's really what the market's doing. You got to adjust your risk to the market's risk. So our risk the risk of our portfolios is modified daily. Sometimes we take more risk, sometimes we take less risk. So even if the client tells us they're super aggressive and they're bulletproof, if the market's selling off and crashing, we are going to get defensive. We're going to move to cash.
Yeah.
And I've got clients all the times, right now, and this market's scared a little bit. And sure, we're down. We're down a lot less than the market, but we're down. And you tell them, hey, I'm really scared. Can you, like yesterday, I got a few calls. Can we get a little more defensive? We already did this morning. We already have.
Already on it.
So we're already constantly making, and that's why I don't really like that. I don't think it's a good model. I think I think it's more about the market and the market's time frame.
Yeah.
Then you got to align your time frame and your risk with what the market is doing at the current time, not just some pie chart for the next 5 years.
Sure.
Things change. All right. Now, I've also got this 7 Themes for Stock Investing by John Buckingham. I posted that on the show notes. You can go read it. It's basically, he thinks bonds are going to be pretty good next year and inflation's going to ease and all this kind of stuff. But it's a mutual fund that's got to be fully invested all the time. He basically said, well, I'm a value mutual fund. I'm down a little bit less than the market, but I'm down. But last year we did good. Well, so basically he's kind of riding a value index. Don't agree with that either, but you can read his forecast.
Yeah.
All right. Now, this is the one that I really want to get to.
Oh, golly.
Because I think this is very apropos and interesting. Earnings, not inflation or interest rates, pose the biggest threat to stocks, says Morgan Stanley's Wilson. Now, Now, Michael Wilson is Morgan Stanley's chief economist, his guy that looks out. So he says the biggest worry for U.S. equities is no longer inflation or even the Federal Reserve's upcoming rate hikes, but rather potential earnings downgrades. The Fed has said to raise 50 basis points. They already did that. He said CPI and the Fed meetings are yesterday's news. The final chapter, those are key words because what he's saying is we're in the final innings of the bear market, according to him. The final chapter to this bear market is the path of earnings estimates, which are far too high. So what he's thinking is that we have another leg down. The market's got to adjust downward, the blue sky, the froth in the market, and price to earnings multiples are too high, and they've got to come down. So with that, Don actually has a very interesting chart. We've been talking about this for about a week now, going over these things and looking at this. And when I saw that article, it just dovetailed with what we were researching and doing. So I thought it was perfectly apropos. So Don, let's talk about that.
Yeah, this is it's ironic that you started quoting that, Dan. That was some of these figures that I took from my chart came exactly from that article, as well as some stats from FactSet. So
Right.
basically, Wednesday, actually Monday, Tuesday, and Wednesday, the S&P closed at 39.91, 40.20, 39.95. Those are the areas in blue here. The forward earnings right now for 2023, depending on who you talk to, are about $225 for the S&P 500, and at an 18 PE, which is historically high entering into a recession, that puts us right here between 39.60 and 40.50. Okay, so basically between $220, $225 in earnings at an 18 PE. However, the market dropped yesterday and today after the Fed, and it's very clear that the big institutions are hitting the exits with stocks. So what will determine how low the S&P goes is two things. First of all, what are the earnings actually going to be come Q1 when they start reporting in January? How will they adjust their forward guidance that will adjust this left part of the table? Are their earnings going to be $225 for 2023, or are they going to drop to $200 for 2023? And then what does the market think that those future earnings are worth? And this is really a confidence measurement. On the bottom end, I have 12 here. In bear markets, we bottomed like 7, 8. Right now, we're up here 17, 18. You don't like to see a combination of reduced earnings and an increasing multiple, because look at these numbers around here. This is where you can end up at the S&P if the multiple comes down and the earnings come down. And the number that keeps showing up in this area is around 3,000. 2,900, 3,000, 3,100, depending on what the earnings are and depending on what kind of a multiple the market is going to place on those earnings. Now, there's a lot that goes into this. Capital goes to where it's treated the best. You're going to have earnings coming out of Europe or coming out of Asia, coming out of emerging markets. You're going to have bonds as a possible alternative to stock. So a lot of it depends on whether or not the big institutions want to put their money in the market, or if they want to put it in the U.S. market or foreign markets. Foreign markets have actually outproduced the U.S. over the last month and a half, but it's primarily been a currency issue as the dollar's been dropping. So this is a little table of some various scenarios of where earnings, what might be, and what multiple the market might put on it. You just cross, it's just earnings times PE gives you the value of the S&P. And in 2 days, we dropped from the blue to the purple. If we're still saying 18 times, does that mean that the market thinks that earnings have dropped to $215? We're right around here right now. We're at 38.30. So right now, that's 225 at a 17 multiple. Arguably, it's an 18 multiple and 210 earnings, or is it 25 earnings at a 17 multiple? There's a lot of gyrations that this can go through, but this gives you an idea at various earnings levels where the S&P can fall to.
Yeah. Okay. So, and what he's saying is right now we're around that 38.70, that purple below the two blue, and that's at an 18
Well,
P.
or here, actually 38.30 right now, so that's 17 at 225.
Okay. Yeah. So, but if you go from that 38.70 or where we are now, and you go to a 16 PE or even a 15, you're talking about easily another 15, 20% decline. Anywhere 10 to 20, depends on how it plays out. So you actually a third leg down is not out of the cards, and that looks like what's sort of shaping up right now. It can always change. That's why we always say it's okay to be wrong. It's not okay to stay wrong. Right now, the markets are decidedly bearish. Okay, all right.
This is actually would be the fourth leg down.
Okay, all right.
Dan, but and there were four legs down in the 2008 bear market.
Okay, all right. Now let's go. So we've kind of talked about that, and people that follow the show know that we're pretty active, folks. If you've got any questions on this, you can certainly reach out to us. If you want a complimentary portfolio view, be happy to look at that. All right, let's switch over and let's go over to. Should we take Michael first, or should we take our special guest? What do you think?
That's a
Zach?
good question. I don't know.
All right, let's try Michael first. Michael, what do you got for us today? What are you looking at?
All right. So all things considered, I mean, this is a sector I'm looking at, always looking for the next potential leaders. Not saying to go out and buy it, clearly, because the markets are under a lot of pressure, and you don't want to step in front of that. But when the markets do turn around, as they always do, a sector that is holding up pretty well and showing some signs of strength and is heating up again is the biotech sector. And there's a couple ways to play that. There's XBI, which is equal weight biotech among its top holdings. So it's got about a 1% weighting in pretty much all of its holdings. IBB
Zach,
is
go to the
concentrated
charts?
in its.
There we go.
Yeah, that's XBI. So that's the equal weight. Then you've got IBB, which is concentrated in the top 10 highest conviction names, which I prefer. I like those holdings, and yeah, I think that they're doing pretty well. And then you've got LabU, which is a 3x way to play it if you want to play it with some leverage. So that's the triple levered ETF, which I highly recommend not doing in a bear market. But if we do turn around, it could be a good way to quickly add some exposure. And a few names in that biotech sector that are heating up that look interesting, that are being held down by this market, but as soon as we go into a new bull, can do extremely well. The first one is Moderna, and that's ticker mRNA. And in IBB, they're about a 6.5% position, and they're 1% position in XBI. So there was some positive news recently, a few days ago, which is why it gapped out of that base, that cup and handle at 189 on some strong volume. There was some news that about some recent trials of their personalized cancer vaccine. They call it PCV, and what they did was so Merck, a company that they partner with, has a cancer drug called Keytruda, and they combined this new vaccine that they've developed, this PCV, and by combining it with Keytruda, it showed a statistically significant and clinically meaningful reduction in the risk of disease recurrence and death from melanoma, and it was by 44%. So that was those are some pretty huge results in the medical community. Everyone's kind of excited about it. The CEO was talking about it. Analysts are upping their price targets and believe that this could be the real deal. And I mean, the holy grail of biotech is really coming up with either a cure or vaccine, something for cancer. So if they can do that, I mean, the sky is really the limit. So we'll see. Um, they plan to start a phase 3 study in patients next year. And what's special about this vaccine is that it's personalized and allows for individual treatment to cancer patients, which is something that currently doesn't exist in cancer therapies. And they plan to expand this PCV vaccine to other types of cancers as well. So the optionality there is huge. So in terms of valuation, how to price this, we'll figure out and see what the market determines is fair. But it's really, I mean, at a $73 billion market cap, if this does work and it is a viable solution, yeah, who knows where that valuation could get to. And then another company that so they've got this company, Exact Sciences, EXAS, gapped up today, not on necessarily news specific to them, but news that their competitor isn't as good as they are, and that their results for they do cancer screening and testing for colon. I think it's called colorectal cancer. So they have the best tests for that, and there was some doubt that a competitor would take them over, but the competitor came out with results last night that were subpar. So Exact Science is where the funds are adding exposure and where the money's going. So there's a lot of stocks in the biotech space that are interesting, that have been outperforming the market. So it's a space I believe is worthwhile considering when favorable market conditions return. So
Well,
that's
so
kind of something
couple
I'm focusing on.
yeah, a couple comments I would make. So Wall Street, the theory or the story behind the pharmaceuticals is they're actually a pretty good place during recession or during weak times because people still have to take their medicine, right? They can't not take their medicine. So sometimes it's considered a little bit of defensive. But when you're talking about the biotech space where they're doing innovation and research and stuff now, what he's talking about, these two stocks, all these cheerleaders are out now because they got some good results. So they're cheerleading it up, which is not a bad thing. It's good. And and he's right. If these cancer treatments do come out right, the sky's the limit. This thing could just take off like a rocket ship. But you will get positive and negative reports going back and forth. You have competitors trying to poke holes in it because they don't like it. It is volatile. These stocks are very volatile, so you got to position size accordingly. They move very rapidly, so you got to just take that with a grain of salt. All right. So without further ado, we're going to bring back a blast from the past. We got Alex the Greek on. Alex,
Yeah.
how are you doing, brother?
I'm doing well, man. It's been a good year, and in talks with Revere every day. Don and I talk daily, twice a day actually, and I try to share my insights on what I'm seeing in individual stocks and sometimes the macro with the overall market. I try my best. I got an interesting story for you guys. This stock, Transmedic, TMDX, if you can pull up that chart. So I'm not going to really go over the technical. Because we're in a bear, you'd really have to be very careful with a newer name like this. But I want to talk about the story, because if we get the right market, this could be the fat pitch, in my opinion. So what this company does is they have an organ care system, and for transplants, they have a heart, a lung, and a liver transplant system. They are working on a kidney one that's down the road. Right now in the world, they only have cold stated product for the organs to transport. The problem with that is there's a high rate of failure. I'll give you some stats. I know Don loves stats. So cold storage, old technology, basically we'll call it the cold storage, is very time dependent, and it can cause ischemia of the tissue. Ischemia is lack of oxygen, so the tissue usually dies when there's no oxygen. We can't have that when someone needs a heart. Okay, they can't have any tissue damage, or the heart, when they put it in, may fail. Right now, only 2 to 3 out of 10 thoracic organs are used. I'll repeat that again. So 30% of current organs are used for transplants. That means that they're throwing away 70% of the donated organs in the world. And post-op, after they put it into the new patient, there's a 30 to 35% complication. So either the organ doesn't take, which could be a blood thing, or it just fails altogether. Some 2021 stats. Out of the 11,400, out of the 15,000 lung transplants, only 2,500 were used. For the 13,000 hearts, only 3,000, about 3,000 were used. Liver was a little bit more, but you can see where I'm going with that.
Right.
They're not utilizing these organs because they either get damaged from the ischemia or the patient doesn't take, and there's a post complication. So this organ care system that they've developed, imagine taking someone's heart and putting it into an environment, this machine, it's about the size of a desk, that keeps a human environment. The heart is actually beating in this machine. So they tie in instruments into the heart to keep it pumping. And the lung instrument actually expands and compresses as if it was actually breathing oxygen. So these organs are still alive. And there's no other company that has this technology. They have patents across the board. They're the only ones there. I'll give you some stats on this organ care system too. There's only a 10% post-transplant complication compared to that 35%. Significant reductions in ischemia, and enables the organ optimization outside of the body. The list goes on with the technology. They have 12 high-volume organ care systems across the country. So Miami, Phoenix, New York, Toronto, there's a list. That tells me that these hospital care systems and the insurance companies are on board, because not only is it going to save the hospitals and the insurance companies a ton of money, but it's going to save the patient. At the end of the day, that's the goal. So the revenue this year was up 95% from last year. They're going to have some problems, though. When I went through the conference call, the biggest issue they're facing is they can't roll out enough product for the demand. So they need to create probably another facility to create these machines to keep these organs going and successfully roll out to more cities. You may look at that as a short-term problem. I think long-term, that's awesome.
Yeah.
Demand is there. My precedent for this stock is 2015. If you could pull up Intuitive Surgical ISRG and put in, 12/16, 2015, you can see the area that this stock started to break out and catch traction. Okay. Now, this is all split adjusted and stuff. But if you keep going to the right on this weekly chart, you'll see a massive run. The stock broke out and it went on a tear. Capital equipment or medical equipment, I worked in hospitals before I got into trading. And to get that big of a machine or costly device into a hospital requires a lot of C-suite pass through. There's a ton of red tape. So the fact that they're already in tells me that the surgeons and stuff are on board. You're not working with nurses and stuff. You're working with heart surgeons, people that are opening up bodies and taking from another person to save someone else's life. So I'm extremely excited about this particular company. But at the end of the day, price action is the only thing that matters. And if the bear market continues, I don't know what this can do really, but it is in the right space, medical. And if we get this is front and center for me, this particular Transmedic company, TMDX. But you can see that roadmap there, what Intuitive Surgical did in the last 15 years, even through the bear in 2008, that big cup on the left there. So, yeah, I think the massive underutilization of these organs, they're going to be able to save more lives too. So it's something I can get behind and believe in. And it's new. And that's the big thing with growth stocks and canceling guys, O'Neill type traders. What's new? What's going to change the world?
The end, yeah.
Yeah, I think this is going to change the medical community completely. And no one's talking about it. I don't hear anybody talking about this company, and that makes my radar go off as far as being early. I'd rather just be early, and if I have to sit through a little bit of pain, I'm willing to do that. So my stops are a little bit wider, not going as heavy. I will build a bigger position over time if we get the right market. As you can see, they're not even making any. There's no EPS, but all the great medical companies, Intuitive Surgical, Suave I traded a few years ago when it was at $50. It didn't have any earnings. So this is like the roadmap for a potential super winner.
All right, Alex, I appreciate it. So a couple of comments I'd like to make real quick. If you look at that chart Don's got up, Transmedics group that Alex is talking about, look how the stock has kind of moved sideways over those last few months. I guess those are months, yeah.
Week. This is daily.
Okay, daily. Okay, weeks. Compared to what the market is doing, I mean, just do stock after stock. Look at other stocks. It's a top left to bottom right. They're all selling off. They're all going down. They're got a negative slope, and this is moving sideways. So something that's moving kind of sideways when most other stocks are going down, that's actually a strong sign on a relative basis. And look at that RS. The relative strength is 99. So that stock is definitely showing strength in an ugly market. That stands to reason.
Yeah, started the year at 20. It's up 200% to 60.
Yep. I mean that is
getting started. That
is strength, folks. And here, one last thing. I know how kind of the medical community works and kind of like that. My father he's deceased now, but he was a retired neuroradiologist. Anyway, you know what's going to push this, Alex? You made a very apropos point. I want to make sure the listeners, it didn't get by them. The doctors are going to be, even if the administrators say, we don't want this, it's too expensive, it's too, we're cost cutting or whatever. If a heart surgeon thinks it's going to drastically increase the probabilities of his patient surviving, you're damn straight he's going to be pounding his chest and going to the administration. And with numbers like that, within like a 44% increase in outcome, you're going to have doctors lining up, all wanting this system. And if these organs aren't showing ischemia and they're actually not atrophying at all, that really makes a difference. That truly is a game changer. So it's definitely on our watch list.
Well, full disclosure, we have a 1% position in it.
Right.
And
we will follow it. And if the time is right, we could add, and that's a starter position. We could add in, and hopefully over time we'll work up to a full position, and then hopefully Alex's theory is right, and it works out very well. Anyway, all right, folks, that's it for today's show. Unless you guys got anything, Don, Michael.
Alex? Merry Christmas.
No, very clear change in character on Thursday after FOMC and following through to the downside on Friday.
Yeah, so right now we're very, very defensive. If you're not, or if your advisor's not, you need to ask why not. Because right now, probabilities are suggesting lower markets, not higher markets. It's not very strong. Folks, listen. We want to wish you a very Merry Christmas and Happy Holidays, Happy Hanukkah, or whatever holiday you celebrate. This is our... Huh? Festivus. We are not doing a show next week. That's 2 days before Christmas because I figured a lot of people will be celebrating Christmas or with their families or Hanukkah and whatnot. And I wanted to give the Revere team a little bit of a break too. So this is our holiday show, but Don will be doing his market update videos every day next week, right, Don? And he'll be doing
Correct.
He'll be doing Friday. The last day of the year is actually on the 30th, not the 31st. So he will be. So you can watch the daily market insights, folks. If you like what you heard, tell a friend, tell a neighbor. Just send them to Revere Asset up in the top right-hand corner. There's a subscribe button. Just have them put their name and email in. We won't reach out to them or spam them anyway. It's up to them to reach out to us for a complimentary portfolio review, talk about topics they want to have talk about on the show. but we do not browbeat people. In fact, I don't even really look at that email list. And you can email any of us with questions, Don at revereasset.com, Dan at revereasset.com, Michael or Ted at revereasset.com. And you can always call us old school at 855 Real Wealth. We will be doing a New Year's show before the end of the year. So there will be one more show before the end of the year, and we'll do an annual wrap up. And folks, we'll talk to you after Christmas on your money.
Because it's not how much you make in the markets, it's how much you can keep.
Yep.